Sir, so basically today I'll be discussing about risk management. If I guess it's too bright. Is it too bright? And yes, open like that. So risk management is what we'll be treating today. So let's kick start. Let's go. Let's go. There we go. So what do I? Because every of the time that I used to talk to you guys about risk management, I used to say risk management. What do I actually mean by risk management? Risk management is one of the key thing or the key aspect in forex trading. One of the key aspects in forex trading because without it without without the knowledge of risk management, you still might not achieve that goal with forex trading, or you might not achieve that dream with forex trading if you don't understand the concept of risk management. And risk management is not the only management that you need to know in forex markets. You also need to know money management and yes, and trade management. So there are three: risk management, money management, and trade management. Those three are together. They are subdivided. So those three is very, very important. Those three work hand in hand: risk management, money management, and capital and trade management. Those three work hand in hand, and this plays a very vital role in forex markets. It plays a very, very vital role when it comes to being profitable in forex markets. As you know before that, risk management is just now people are saying is 40%. No, now they are saying is 70, 30, 10. Okay, it's 20%, but it's more than that because psychology is actually 70%, and your technical analysis is 10%. So it's basically 20% of in ratio is basically 20%. But it's very, very important. It's very, very important. So without wasting much of that over time, I said risk management, money management, and trade management. They work hand in hand. So what does risk management actually mean? Risk management is just how much am I knowing how much you are willing to risk on a particular trade. Knowing how much you are willing to risk on a particular trade, that's basically what risk management is all about. Because a lot of traders make that mistake of just seeing someone make thousands of dollars from forex market, and tomorrow you too want to start trading forex. You want to start trading the forex market, and you watch some YouTube videos and you download MT4, MT5, you fund your account and you start placing trade. At the end of the day, you lose or blow your funds, and you come and say forex is a scam, or people that are actually trading and showing the results, they are not real. The results are fake. They are not real. But because of just that little video you watched on tech analysis, you want to start trading the markets. It does not work that way. You need one part out of three. You need only one part about the business you are going into. Don't expect profitability from that business, because you really don't have any idea about what it really is. So risk management is very, very important. So first of all, before you take any trade, you need to sincerely ask yourself, even before you fund your account, you need to sincerely ask yourself that, okay, this $10,000 account, or this 1,000, or this $100 account that I want to fund, how much can I actually, how much can I actually, how much loss can I actually take in a day? And I will not go back and drink Gary. Or how much loss can I incur in a week and I'll be fine with it? That's the first thing. You need to clarify that question first. You need to answer that question first before you even start anything. Before you even start your day or your any of your trading activity, you need to first ask yourself that question. How many amount of money out of this fund that I have, how much can I actually take? Like if I lose this money in a day, will I be okay? Ask yourself that truth first. And you need to answer that question sincerely. You need to answer that question sincerely because Forex, if you lie to yourself, you get humbled. That's just it. You get humbled to humble you. And when it humbles you, Forex market will keep going, but you are the one that lost. So you need to first ask yourself that question. When you figure out that, okay, well, out of this $100 account, I'm willing to lose or I'm willing to risk $10. I'm willing to risk $5. Even $2 is still okay. I'm willing to lose $2 on every trade I take. Good. That one is cleared. Now, the next thing you want to be asking yourself is, what is the lot size? Excuse me. What is the lot size that requires to lose this $20 on this kind of on this my trading account or this my trading balance? What is the lot size required? That's number one. Number two is how much pips stop loss. Based on my backtesting, based on my way of trading, I've seen that okay, my stop loss, where I put my stop loss is most time 30 pips, most time 40 pips, most time 20 pips. Check the average of all the trades that you take. Or to make things very simple, you can just go to this website called Position Size Calculator. You already know that one before. That you just go there. This is basically it. You click the pair that you trade, you assign it there. Account currency is always in USD. Your account size, you put it there as well. Okay, I have $100 account, and okay, if you swap to money so that in case you don't know the percentage of the risk, you can just swap to money and you change it. So okay, I'm willing to risk $10 on this trade. Okay, on every trade, that's what I'm willing to risk. So whenever you now see your trade setup and you want to place trade, so you first of all let me go to lower time frame so that you can see what I'm trying to show you. You first of all, first thing first, you first of all, that zone that you're trying to get an entry from, you just place your tool there. Okay, I want to long this market. I want to buy GPUSD right now. That's the first thing you do. Now, where am I going to put my stop loss? Stop loss placing is also another topic that you need to learn when it comes to risk technical analysis. So knowing where and when to place your stop loss is also very important. So on this pair, okay, I'm willing to buy, and the stop loss I'm getting, because I want to put my stop loss above this, below this low, I want to just place it here, and I want to target times two. Yeah, this is it. This is where you see this is now 1 to 2 risk to reward. So I want to put my stop loss here, and what's the stop loss? Pips, which is here, 26 pips. Okay, just want to go to your position size calculator. You are risking $10 on your $100 account, and the stop loss pips that is giving you just 26. You just input 26 and you press calculate. This will help you calculate the lot size you are going to use in order to lose this $10 and make $20, which is times 2. you need to use 0.04 lot size on your MT4 or your MT5 in order for you to lose this $10 and make the $20 target that you have. So this tool is very, very useful. This website is very useful. They help you just calculate it. If you don't have a fixed lot size, and if you don't have a fixed lot size and also a fixed stop loss, because you might be willing to put your stop loss below here, and you can see that the stop loss pips increase. So 56, okay, you want to put 56 pips and you want to still risk your $10, you can just input 56 and just calculate it for you. You see 0.02. So the higher the pips, the smaller the lot size, and the smaller the pips, the higher the lot size. Just understand that. So, and it also, the smaller the pips, the larger the account size and the more money you get to make. But at the end of the day, if you're targeting 1 to 2, it's still fine. It's still the same thing that you still like end up with. So that is that on that. I need to understand that stop loss placement, it actually helps you as well to determine the amount of money you are willing to risk on a particular trade. So that's that on calculating your lot size when it comes to risk management. So your stop loss pips with the amount of money you are willing to risk will help you to determine how much you are going to lose on a particular trade. And I said it on my last, I think my second video, that trading is actually not risky. Yeah, I said it. I said trading is actually not risky. Why? Because it is the only game that, or the only business that you can actually predetermine your loss even before you incur that loss. So basically knowing that, okay, this $10 you are willing to risk on this particular trade, you actually don't feel it whenever you lose it. Whenever you lose that money, you actually don't feel it, and you just accept it like that. You get. So trading is not risky to me. My own opinion, is not risky. So that's one point on risk management, which is getting your lot size and also merging it with the stop loss pips that you need or that you have or that a trade is giving you. The second point here is money management. Okay, money management is, I've already explained it. Money management is basically you sincerely telling yourself how much you're willing to risk on a particular trade. Why the risk management is where, yes, sir. Yes, I've done it, sir. Why the money management is actually, money management is you willing to risk a particular amount of money. You knowing the amount of money you are willing to risk on a particular trade before you take the trade. And risk management is where you get to calculate the lot size and stop loss pips in order to know, or in order to get that lot size you need in order to lose that money that you are willing to lose. And again, trade management, which is the third one. Trade management, let me explain with charts. Trade management is, and there's one trick about trade management that you guys don't understand, and which is this. When I called out this trade, right, our stop loss was above here. You can see this line because it's like a resistance zone. The market is failing to break above it. So my stop loss was above it. So as trade was going in that direction, we started to what? Reduce our stop loss. Now, what do you observe here? What do you observe here? Not to waste your time. What you observe here is the risk to reward increases. Now, this is how it works. We're actually risking 28 pips to target 1 to 2. Okay, I think it was 25 or 26. Let's pull out 25. To target 1 to 2, we are targeting 51 pips, right? We're targeting 51 pips. So as trade keep going in our direction, we started to what? Reduce our stop loss. Reducing our stop loss also means reducing of our risk. Initially, when this trade was 25 pips, let's be practical about it. We have $100 accounts, right? And we are willing to risk $10. And the initial stop loss pips was 25, 0.04, and we are risking 10%, which is $10. Now, as this and we are targeting times 2, which is we are going to make $20, right? As we reduce our stop loss, our risk to reward start to increase, and our risk also reduce, meaning that our risk reduced drastically, but we are making even more profit. I don't think you understand what I'm saying. Okay, initially we're risking $10 and we're targeting $20, right? As trade started going in our favor, in our direction, we started reducing. We had 17 pips, right? Now let's input 17 pips there. 17 pips. So what's up? 17 pips, right? Our risk reduced. You will not see it here because this is just like this is a fixed this is a fixed risk. Yes, ma'am. No problem. Sorry, a minute, please. So sorry for that interruption, please. Okay. So as I was saying before, that this is a fixed risk, so it will not change. The risk will not change because we already fixed that it's $10 we are willing to risk on that particular trade. So as I can actually do it on calculator. You can actually calculate it. You can actually calculate it even with your phone without using that website. So basically, we're risking 25 pips. So 25 times what was the lot size they gave us before when we were risking 25 pips? 0.04. So 25 times 0.04 times 10. And what do you see here? I don't know if you can see it. 25 times 0.04. You can see there, 25 times 0.04 times 10. That's $10. You can see that's $10. Okay. So as time goes on, as we reduce our stop loss to 17 pips, so you change it 17 pips times 0.04 times 10. Initially, don't forget, we are risking $10 to get $20, which is times 2. But now we've reduced our stop loss, right? Reduce our stop loss to 17 pips. Now, when you now multiply it together, how much are you now risking at that point? You say you're now risking $6.8. $6.8, which shows that you are risking $6.8, and you are still targeting $20. You can see that the risk to reward is now increasing. The risk to reward is increasing. You are risking less to make even more. You are risking less to even make more. And if you keep tightening your stop loss, your risk keeps reducing and your profit becomes even huge. You get? So trade management, it is very, very important, because first thing first, the first mindset you need to have when you're on a trade, or when you want to trade, is survivor mentality first. Survivor first. Your capital. You need to secure your capital first. First thing first. Secure your capital. Secure your capital. And there are tricks to this thing, this trade management. How do I start to manage my trade, or when do I start to reduce my stop loss? And here's the thing: whenever there is a new high or a new low, you should reduce your stop loss. Let me use like a line. So let's say the chart was like this, and you bought here. Let's say you bought at this low here. You bought at this low, and your stop loss was below this low like this. Let's say below the low like this. And market starts, and you know that this is one high here. Like, this is a new high here. Like, this is the high here. This is one high here. So whenever market breaks that high to form a new high, you reduce your stop, because market will not come back. That is certain, and it's for sure, most especially when you are following the trend. Most especially when you are following the trend, markets will definitely not come back into this zone. It will not. It will just come back, retrace, and head to the upside. So whenever there's a new high, a creation of a new high or a new low, that's when you start to reduce your stop loss and you start to manage the trade. So that's all on trade management, and I hope you actually learn something from that. I hope you learn something from that. So that's basically the three things that you need to watch out for. You need to know very well when it comes to trade management, risk management, and money management. So first, money management. Let me just write it out. Money management. How much am I willing to risk on this trade? You need to be very clear with it. You need to be clear, and you need to be truthful to yourself. You need to be truthful about it. You need to be sincere. Okay, so um, you why is it not showing? Why is it not showing? Are you guys with me? Do you guys? I did not left. I did not leave. Oh, I said I did not left. I did not leave. I'm still with you. Can you guys hear me? And do you see what I was saying throughout? Are you there? Okay. So do you hear what I said and do you understand everything? Okay, you understand. Sharp, sharp. Marvelous. Do you understand everything I said? Marvelous, are you there? Just send me a DM if you understand. So I think that will be that for today. Thank you so much for your time and peace out as always.